I shall now briefly set out the rationale for these decisions. The MPC took note of the recent slowdown in the growth momentum, which translates into a downward revision in the growth forecast for the current year. Going forward into the second half of this year and the next year, the MPC assessed the growth outlook to be resilient, but warranting close monitoring. Inflation, on the other hand, surged above the upper tolerance band of 6% in October, driven by a sharp uptick in food inflation. Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March. And we expect that this is the trend, and it will be backed by seasonal correction in vegetables prices, Kharif harvest arrivals, likely good Rabi output, and adequate cereal buffer stocks. High inflation reduces the disposable income in the hands of consumers and dents private consumption, which negatively impacts the real GDP growth. The increasing incidence of adverse weather events, heightened geopolitical uncertainties, and financial market volatility pose upside risks to inflation. The MPC believes that only with durable price stability can strong foundations be secured for high growth. The MPC remains committed to restoring the inflation growth balance. I repeat, the MPC remains committed to restoring the inflation growth balance in the overall interest of the economy. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting, and also to continue with the neutral stance of monetary policy, as it provides flexibility to monitor and assess the outlook on inflation and growth, and then go on to act appropriately.